Second liens, second mortgages, piggyback loans, they all mean the same thing. This is second mortgages explained, right? So we're going to go through kind of what each one means. Again, as I mentioned, those terms are just generic ways of saying the same thing. So what a second mortgage is, or a second lien, or a second note, it's a mortgage that is sitting behind another mortgage. So maybe somebody bought a home, they got your traditional mortgage, and now they need or want cash out or home improvement loan or something. And so they go get a second mortgage. Or some scenarios, which not as common in today's world, but it used to be very common. When they're buying a home, they may get a first and second mortgage. So let's talk about what that, kind of what it is and when they need them and why we do them. So ultimately, to do a split, financing or something like that, when you buy the home, it's getting two mortgages. You're doing one loan to buy it, or you're using two loans to buy it. One loan's kind of the main primary big one, and then you get a second smaller one. Or, like I said, later on, you can get a second. But let's take it chronologically and say somebody does this and gets two loans to begin with. First of all, why would they do that, right? So in the old days, it was used as a way to avoid mortgage insurance. And old days means like early 2000s, maybe the 2010 period, whatever it was, mortgage meltdown happened. And then suddenly the mortgage insurance companies got more aggressive. Maybe second liens got a little higher. It was just this slow transition to where suddenly it wasn't quite so prevalent because the numbers didn't work out. They just didn't make as much economical sense to do this. But it used to be like the standard way of doing it, where you'd get an 80% first. Like if you've heard 80-10-10, that was 80% first, 10% second mortgage, and a 10% down payment. Or you'd hear 80-15-5, a loan for 80%, second mortgage for 15%, and then the third number, which is that 5% is your down payment. So it'd be a way of doing this to avoid mortgage insurance. It worked really well. The blended rates were really good. All of a sudden, somehow, some way, that just wasn't the case anymore, where the mortgage insurance companies got real aggressive and probably were losing a lot of business, is my guess, and they became better. So you don't see as much split financing in terms of the purchase in today's market, but certainly you can. And the real key there is to look at just the blended rate. So if you got a first mortgage, making this up, first mortgage is 6%, second mortgage is going to be 8.5. You got to figure out what that blend is, because if you got, it depends on the loan size and how you split it up. Figure out what that blend is, and then you can decide if it's worth doing that versus one loan with mortgage insurance. So that's for the mortgage professional to do, something that the Mortgage Mark team will absolutely help you out and get done for you. But that's the reason why people used to do split financing when they bought the home. Another reason why in today's world, if somebody does a second when they buy it, is maybe they're selling a home after they buy and they just want to pay off that second mortgage, where they can say, okay, I'll get the second mortgage for a random $137,000 because they think that's what they're going to net when they sell this home, and then just use that and have that money go away. There are ways to avoid that with a recast. So check out recasting. It's a way of accomplishing that without doing the second. That's another reason why the seconds aren't as prevalent these days. But maybe there's a loan program that won't allow them to recast, and maybe that's why they do that. So check that out as well for the recast to see if that's something you want to do. But like I said, the old school way, they did it to avoid mortgage insurance. Maybe they did it to avoid jumbo financing. So like if you buy in a really big home, the conforming loan limits, which do change, seems like annually, to stay under the jumbo realm, they would maybe get a small second so that you can get maximize the conforming conventional loans and then get a small second. So that'd be another reason. And after that, like I said, the bridge loan, where they might get a small second, so when they sell this house, they can pay it off. That's a type of bridge loan. That's not a real bridge loan. Again, we'll put a link so you guys can see more information about bridge loans. But those are the reasons why somebody would buy a house and do a first and second. Now, let's talk about second liens after you bought the house. The two main reasons why somebody get a second lien after they bought a house. They already got a mortgage here, and they now want to get money for some reason, whether it's home improvements or whether it's just to take money out to pay off debts or go to Vegas or do whatever they want to do. That's why the second mortgages will typically come in, is they need access to the cash, whether they want to go spend it or do a home improvement loans, up to them. But those would be why somebody might get a second mortgage. And you do that. We see a lot more of those today because people from COVID are sitting at 3% first lien rates, like their first mortgage is at 3%. Rightfully so. They don't want to refinance those, especially if they only need like 20 to 50 grand when their current mortgage is at 500. You don't want to redo a 3% rate at, higher rates just to go get 20 grand out of the house. So that's why second mortgages come back into play, and they've been very prevalent in the recent years. just because they have, again, that really good low rate first. So when you get a second mortgage, just so you know, now that you say, okay, I'm going to go get a cash out or I'm going to get a home improvement, and those are two different things. So a home improvement loan, and again, I'll put a link in here, you can borrow more than you can on a cash out, so long as all the money goes towards home improvements. And there are ways to do that. So I'll put a home improvement second lien link in here to show you that. But those are two different things. But ultimately, they're going to go in and get you a second mortgage. The cost for those, typically not much. I would say, generically speaking, probably $1,000 or less, $1,000 or less. There are many instances where I've seen it be zero cost. The $1,000, maybe 500-ish goes to the person doing the mortgage, the bank doing the mortgage, and then the other 500 to 700 might be the cost of the appraisal. Some second liens don't require appraisals. Whatever's online is what they're going to use. They have access to data, they'll do it. So they certainly can go that route. The term. Let's talk about the terms for second liens. These things typically aren't going to be your normal, air quotes, normal 30-year fixed rate principal and interest. They can be, but more often than not, you're going to see the shorter duration. It's going to be 20 years, maybe 15 years, 10. You can even go down to 5. So these could be fixed rates where it's 10, 15, 20 years. Maybe you see 30, but that's not very prevalent. A lot of times what you may see is what's called a 30 due in 15, due DUE. Means it's amortized over 30 years, but it's going to be due in 15. So it's a balloon payment. It says 15 years from now, if that second lien's not gone, then you're going to owe all that money. You got to refinance it or pay it off. And those are popular because most of the time people are going to either pay it off aggressively or maybe they've sold the house or refinance between now and then. So it's very, very, very common. You might see some where the rates are variable, like HELOCs will have variable rates. But those typically HELOCs are about the only ones I typically see that have variable rates. As far as the rates themselves, they're typically going to be higher. They will be higher 9 times out of 10 because then what you compare for your first mortgage. So if you see rates in the paper saying rates are X, understand that for second liens, they're going to be higher. Why? There's more risk. If somebody were to get foreclosed on, the first lien gets all their money before the second person gets anything. The second investor gets anything. So there's more risk to it. So the rates are typically higher. The only reason I use the word typically, maybe there's a bank promo and they're giving you some special promo rate for the first year, but in general, they're typically going to be higher rates than what you're going to see on the first mortgages. Credit requirements, they're banks. They're going to be a little tighter than normal, so they're not going to have as much flexibility as you might on the front end if you just did a solid mortgage, cash out or something like that with us. For points, like I said, you typically don't see a lot of points for those things. A lot of times you can even avoid title policies. So keep it under like 250 or less. So ask 250,000. Ask the bank again. Call us. We'll point you to the direction. We have different banks for different options. So call us and we'll tell you who we like and recommend. Technically, can we do these second liens? Yes. But normally, in most markets, we're going to refer it out to people we know, like, and trust. We don't get paid anything for it. That's okay. We're here to help you, but call us and we'll walk you through it. But typically, you don't see a lot of points. Costs are usually very minimal. Prepayment penalties. Most probably won't have a prepayment penalty, but you need to at least talk to them to make sure and talk to us. We'll help walk you through it. There can be prepayment penalties if you're not careful. So we'll go through and walk you through and see if it's worth having one or not having one. And the time that you might say, well, why would somebody have one is like if you're getting a mortgage for like 3 months, you're just doing this like a bridge loan and it's a form of a bridge loan. That's typically when they're going to charge some money because they need to make some money. But if they only have the mortgage for 3 months, they're not going to make a lot of money. So we'll walk you through the prepayment penalty piece. There, as I mentioned, there are balloon options, right? So the 30 due in 15, that is a balloon. More often than not, if you pick just the normal first rate or something like that, you're not going to see balloons on that. Some banks will require a membership, like a credit union might say you got to be a member. I know when I closed mine with a bank, I had to open up a $25 checking account. Might still have the money there, I'm not sure. But that may be normal. So don't be surprised if they say, hey, you got to open up, or create a deposit or do something with a bank account that they want you to make and create. They might have random due dates for your mortgage payment. So like if we close on the 22nd of the month and you got a second mortgage for a purchase, they may make the 22nd when your mortgage payments due every month, not the normal typical first of the month through the 15th. So they might have random due dates. So be sure to check on that as well. And then lastly, they will have their own set of closing documents. So if you were to do a which makes total sense. But if you were to do a purchase that had a first and second, you still got 2 sets of paperwork to sign to get all that done. So I know it's a lot of information, but at least kind of goes through and tells you what's required, what the different types of loans you can get. Again, typically second liens in today's world are used for cash out purposes or for home improvements. You don't see a lot of the purchase ones, but certainly if you have questions or somebody recommends it, let's talk about it. The Mortgage Mark team is here to help. And as always, and you know this, when you think mortgage, think Mark.